Hello, everyone, and welcome to another episode of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker, licensed real estate broker right here in Santa Clara County, California, serving this local area since 1988. So I've been doing this a while, and hopefully I will be able to share with you some of my expertise and insights into the world of real estate to help you make better decisions. And in that spirit, this week we are chatting about the process to help you decide whether or not it is time to consider selling your investment property. Now, this is a topic that's very near and dear to my heart right now because I just went through this process myself. This is my first show back after taking a bit of a hiatus. I took the entire month of September off. That's why there haven't been any shows for the last few weeks. I actually spent it in my own investment property located on Oahu, Hawaii, and did my own assessment. What did I want to do with this property? And it's an interesting one because there is absolutely an emotional element to this. And I realize I tend to focus on what are the numbers, and we'll absolutely do that. We'll cover the numbers of what you need to digest in order to make a good decision here. But there's also the emotional element of it. And instead of simply dismissing the emotional element, we're going to try to focus on how do you integrate those interests into making the decision that's going to work best for you. Because sometimes the best decision for you isn't the one that leverages your finances in the best way possible, but that makes you the happiest, right? So let's go ahead and explore this. So we're going to go ahead and jump in and start with what is the process for you to evaluate whether or not your investment property should get sold. Now, this will work for any investment property that you're holding. From a mathematics standpoint, it'll apply to all of your holdings, whether it's a short-term rental, long-term rental, multifamily, whatever the situation might be. This is what you need to do. And I often suggest to my investor clients that they go through this process at least once a year. Do an evaluation, figure out where you are, take a look at the markets that you like to work in, and see if it makes sense for you to consider liquidating one asset in order to move it to another asset that would leverage your money in a better way, or maybe leverage it to the exact same amount, but diversify it. So we can talk about all of those considerations. So the first thing we want to talk about, and I've been trying to decide whether I wanted to jump right in and just do what is your return on investment. But I think what I'd rather do is kind of focus on the rational versus emotional satisfaction element of it. And this is the second part of this. The emotional part is obviously going to be different for everyone, but you may own a property that you currently use. And I know an awful lot of people who do this, and you get this property and you hold it, and your goal initially is simply to cover your cost of holding the property with the hopes of banking enough money that you might make improvements to it down the road. And who knows, this may be property that's been in your family for decades. It may be one where you have very strong, satisfying memories about your time at this property. Now, in my case, the property that I was evaluating, and I was actually there for most of the month of September, really taking a hard look at what made sense for me right now. And for me, this is an emotional one. There's definitely an emotional element. And for a lot of us, I think it's important to consider what value do you put, and it's difficult, I think, to put a value on an emotional consideration. But what are your emotional attachments to this property? Are they ones that you can live without? And if they're not, the equation simply becomes working out the math to keep it and to do the best with it you can and hold on to it. My emotional connection to it is, as some of you may know who've been listening to the show for a long time, every once in a while I'll bring up my boys. And I have 3 sons, and I have twins. And my twins' second birthday was at this unit. And this is a place in Hawaii right on the beach. It's beautiful, and I love spending time there. But I think in terms of emotional connections to past things, while I've always kind of enjoyed that and it's always helped me sort of recall those things, I don't think it's not mandatory for me to keep this property in order to continue to cherish those memories. And in staying there again, back when I was first using this place, whenever I would go and stay there myself, I was in the ocean 2 or 3 times a day, every day. I was there for over 20 days, and I just didn't do it as much as I used to. And I don't know what causes that. And this is a super personal thing, right? This is just me sort of listing off what are the reasons why I would keep this property? Because it's absolutely profitable. So in theory, I could continue to own it. But let's talk about return on investment to start off. And return on investment is just the math, right? And that's you figuring out how much equity is in the property. How much cash money do you have in the property? And then you list out all your expenses. You need to cover everything. So in my case, there's the mortgage, there's the HOA, there are assessments, which comes up frequently. And some of the assessments that have come up on this particular unit have eaten a year's worth of profit from doing short-term rentals of this unit. Utilities, everything, right? Make sure you have pinned down what the real expenses are. And I have found with many of my clients who've gone through this process, they have forgotten to include any random assessments that have come along. For me, if there was an assessment 20 years ago to purchase the land that the condominium building is on. In Hawaii, it's typically a leasehold situation where you rent it for 99 years, but there was an opportunity to buy it, and they did that. And there was an assessment for all owners to cough up the money that was necessary to make that deal happen. There have been assessments more recently relating to building upgrades, and that's all fine, but HOA fees are already through the roof. I personally despise HOA fees, but you're not going to get a condo without HOA fees. But many of you are used to HOA fees that are $200, $300, $400, $500. Once it starts getting to $1,000 a month, that's obviously cutting into your profits. And since I have owned this property on my own for the last 13 years, 12 years, HOA fees have doubled since I bought it. And of course, you can't control HOA fees. HOA fees, which is why I don't like them, right? When you're calculating how much your property is generally going to make you fixed costs are preferred, right? So make sure you're adding all of those things up, including the utilities, whatever else. And this has been a property that I've been doing vacation rentals for the entire time I've owned it. And then I would obviously reserve time for myself to go and stay in the unit myself. I have been very hands-on, so my management costs have been relatively low. But I'm looking to change that. So what I was doing over these last few weeks while I was staying in the unit was really getting down into the nitty gritty. I was interviewing property managers, figuring out if I handed this off to someone else as them handling it 100%, with me just seeing checks come in, how much would I be getting per month? And that's, again, an easy thing to figure out. You typically take the history of your unit, what's it been making, you project that forward with whatever yearly increases you've been doing in your daily rate or your monthly rate, depending on how you rent the unit. And then you calculate it in with this assumed cost of property management. And basically, my property management cost would have doubled by handing it off 100% to someone else, which is fine. I was fine with that. But I also ran the numbers if I continued to property manage it myself, meaning I just had someone on site to greet guests, etc. And here's the payoff here is what you do is you take what you're making monthly after you've accounted for all expenses, remember to include assessments, and then you divide that by the total amount of money you have invested, and then that gives you your yearly yield, right? Now, in my case, that came out to just over 6% return on investment. That's not awesome. Most investors I work with, we like to say as close to, we try to get over 10% or more. 6% isn't terrible, but you want to be in a scenario where you're beating at least what a index fund in the stock market tends to make. Now, there's also the idea that you can roll in appreciation and those other things into the equation. But for me, simply by taking what your equity is takes into account appreciation. For instance, if you bought something at $100,000 and it's now worth $400,000, when you're doing this equation, you're including that appreciated amount in what you have in the property. And what I realized was I could sell that unit, pull the money out, and I could buy 2 income properties that would then make me, as a percent of the money invested, make me as much or more, and then it would, but in addition to that, it would diversify, right? So instead of having all of that money wrapped up in one property, where if it's not renting, you're making zero, I could take those same funds and divvy it up between 2 different properties that would then potentially make me more money. Or I could buy a multi-family unit. I could buy something like a triplex or a quad or larger in other markets. My local market, that just wouldn't work here in local Silicon Valley, California. But in other areas, that would work out very easily, and it would also be less headache. The management fees would be less because vacation rental management costs in most markets I've seen more than double what it does to get long-term rental management in place. And there's no HOA fees, right, if you're doing these, so there's no random cost that's going to increase on you over time. And overall, it was just less of a headache. So for me, running the math, it made sense for me to move my equity out of my holding in Hawaii and into a different property elsewhere. But there's also additional things to consider, right? So we've talked about the emotional. We've talked about the rational, which is just the numbers. Well, how much is your money making you, and is it enough that you're satisfied with? But it's also the circumstances. Now, the island of Oahu, being its own county, is definitely out to kill short-term rentals as much as possible. In fact, this is happening in a lot of communities across the country. So leaning into markets where property rights are more respected is, I think, a reasonable consideration as something that you're looking for. So, and don't forget, when you're doing this, I want you to not just get what the percentage is. I want you to also look in the local markets that you're willing to invest in and do some tabletop math to figure out what your return on investment would be. Now, some of the communities where I'm looking right now, I'm looking in Phoenix because that's becoming more and more attractive as prices drop there. I'm also looking, and that's greater Phoenix, right? Not just Phoenix, but all the surrounding areas, all the greater urban sprawl of Phoenix. But I'm also looking in Boise, Idaho, Salt Lake City, Utah, areas where, from the data that I've accumulated, then this could be different for you. If you're someone who's not comfortable with long distance property ownership, just be looking in your local areas. But make sure that you're looking in areas that are realistic competitors to what you're currently holding. So if, let's say you had $100,000 in equity in a property that was only making you 6%, like mine is making me, but you could take that money and put it into a different investment in another market and make 8% or 9% or 10%. That would be a more aggressive application of your equity in something to generate what you want to generate in terms of return on investment for monies that you have invested in a property. Now, once you've got all of that data in one place, you should compare it to realistic, real-world options you have to reuse that equity elsewhere. Don't just assume that, well, the number's only coming out to 6%, so I need to find something better. That may be true, but it may not fit with your willingness to pursue other options. So don't just assume you're going to be able to find something else. Actually find something else. Now, does that mean that you have to hurry to liquidate that other property to purchase this new property? No. If you find one in a relatively short period of time, you're able to find another one. So you can still liquidate that property, then start the process of finding the property that's going to work mathematically for you to give you that greater return. Now, I always suggest, and here's one reason why I wanted to go over these numbers again. When you're going through the acquisition process, whatever you are thinking you're going to spend, so let's say, for instance, that if you put $100,000 down on a property and you do nothing else, but then you turn around and rent it, let's say you'll make that better than 6%. You'll make 8%, 9%, 10%, whatever. Or maybe you're just going to make 5% and you're using that money because you were only getting 2 or 3% return on a previous investment. So let's assume you go through that process and you definitely ascertain how much you're currently getting, and you start looking in the markets that you like and you can't find anything that's going to make you greater than what you're currently making. Well, then there's no reason to change, right? You've done your due diligence. You've gone through the process. You've looked at what is currently available to you in the markets that make sense to you, and you haven't been able to find something that represents a good deal. Now, the other thing to keep in mind is additional expenses. So you've got this $100,000. I always like to assume, and this is something you're going to need to do on a case-by-case basis. In some cases, you're going to find something that's move-in ready, you do your inspections and discover there's nothing in there that needs any work. But I always assume there's going to be some amount of work that has to get done. And you're going to have to go for your instincts on this. I would say at least have a 10 to 20% backup plan in terms of things that may come up. But usually if you go into it and once you've done this a little while and looked at a few properties, you're going to get an instinct for how much additional money you're going to have to invest in the property after you've purchased it. But always make sure to account for that. Not sure what to tell you as a blanket number simply because there's so many different regions across the country. If you go with that 10 to 20% number, I think that's relatively smart. But I would include that in your math in terms of understanding this is how much cash I have invested into the property. So if you take $100,000, you purchase that property, let's say you have financed half of the purchase price. So you owe an additional $100,000, but you've got $100,000 in. Then you end up having to spend $10,000 on various things. Maybe it's the bathroom needed an upgrade. Maybe the plumbing was having a problem. Maybe there were some electrical issues, air conditioning, heating, whatever. Then you get those things taken care of. So the new number is not $100,000. It's $110,000. So that when you're figuring out how much you have into it, make sure that you've calculated that $10,000 upgrade, update, or remodel that you've done to the property. And in my case, I have kept track of every expense along the way as I've held this property. So I know exactly per year how much things have cost me. And then you would simply use that's how much I have in it. That's how much money is in the property for me. And I want to make sure and make that return back and base that on a real percentage that reflects the amount of money I really have in the property. Now, of course, if you're local, I am happy to walk through this with you with your investment properties, or even if you're not local, happy to sort of have a conversation with you. Feel free to reach out to me. If you've got any questions or concerns, make sure to post them in the comments. If you're watching this on YouTube, you can also post comments at my website at soldbyrobert.com if you're watching this there. And of course, if you're on the podcast, thanks for listening. And you can, of course, visit me at soldbyrobert.com to get in touch and ask any questions or make any observations relating to your interests in potentially liquidating your investment property. Now, as always, the goal is to leave you with more knowledge on the table than we take up in your time. I absolutely hope we have achieved that this time around. Thanks for listening, and I will talk to you all next time.